online tomorrow. I'm pleased to represent Reed Smith once again at a great Marine Money event. We've already heard from prior speakers today. The shipping markets are evolving, driven by changes in market dynamics and decarbonization efforts. Turning to the capital markets, particularly in the United States, we are experiencing uncertainty and volatility stemming from both macroeconomic factors and the continuing war in Ukraine, which we've heard a lot about again today from the prior panels. On a brighter note, it seems, at least for now, that the pandemic is not having the amplified effects that it was last year when we sat together at this time. But it's nice to see so many of you here, and you're going to be rewarded with a wonderful panel today. So our panel consists of Doug Mavrinac, who is the Global Head of Maritime Investment Banking at Jefferies. As many of you know, Jefferies has been committed to the shipping industry for decades at this point. And the next two gentlemen are with Greek shipping companies that are publicly listed in the United States capital markets, each with a different sector focus. First, Haris Kosmatos, who is the Corporate Development Officer at Tsakos Energy Navigation, or TEN. TEN is a diversified tanker owner that's listed on the New York Stock Exchange, and its stock price has increased significantly so far this year. And Stavros Gyftakis, the Chief Financial Officer at Seanergy Maritime. Seanergy is a Cape-size dry bulk fleet owner that's listed on the NASDAQ capital market, and its stock price has declined somewhat this year, and it's truly a tale of two sectors. Okay, so thanks all for coming again, and let's maybe get some opening thoughts from each of our panelists. And let's start with Doug. Doug, over time, and in general, the capital markets have been very useful, if not unique, in meeting the funding needs of the shipping industry, particularly in light of the vast new building projects that owners have undertaken by replacing construction loans, providing the capital necessary to complete projects. And what are the capital needs of the shipping industry today? And do the capital markets offer, in your view, a competitive financing alternative to traditional sources of financing and private equity?
Yeah. Okay, thank you, Rob. I'll answer the second part of the question first, and maybe leave the first part for the issuers on the panel, just because they have a different perspective than me, who helps facilitate transactions. And so the capital markets provide, I think, an invaluable service and resource to a lot of constituents within the shipping industry, owners, investors, et cetera. And so there's a whole host of reasons why a company, an investor, may consider a capital markets transaction. As mentioned, I'll leave the reasons for Harry and Stavros. But what I was hoping to do to answer your question is, instead of talk about theory and what should happen, what could happen, is to talk about what has happened. And so for the last year and a half, so starting in the beginning of 2021, people think the capital markets aren't necessarily open, but I'll rattle off 10 quick deals that we've done in the last year and a half to kind of highlight the use of proceeds, why people are tapping the capital markets, and just to highlight, and you'll see a theme kind of develop. So in early 2021, we helped Global Ship Lease do a primary equity raise. It was for growth. They were pursuing an acquisition and basically using the proceeds to fund growth. But at the same time, it created a more liquid security, improved the liquidity, which I'll get to in a moment. But there was one for growth. The second was Zim. So we did Global Ship Lease in January of 2021. Zim was like January, February, something like that. That was primarily to give investors a monetizable security. So that's where you're starting to kind of see a theme that's about to develop. Taylor Maritime took them public in April of 2021. Growth, but also they had point state in there that needed an exit. So then you start getting into, all right, well, Global Ship Lease had a better security, more liquidly traded security after the raise in January. We helped Moss Capital get out of Global Ship Lease. And then a month later, we helped Kelso get out of Global Ship Lease. And then in June, July of 2021, a lot of investors in Zim had a secondary that they sought to exit. Early this year, Point State eventually got out of Taylor. Last fall, we did something for Grindrod Shipping. The Grindrod family got out of Grindrod. And finally, 3-4 weeks ago, Oaktree used us to get out of their shares in Hafnia in Oslo. So last year and a half, 10 transactions, 2 IPOs out of all of that, transactions in the US, transactions in Oslo, transactions in London. but about 8 of the 10 were for exits. And there's a reason why, is that, whenever companies are making a lot of money, you call up, owners and, markets are open. Oftentimes they don't necessarily need the money whenever things are good because they're generating so much. But just, from our perspective, that's what we've been seeing in the capital markets and the service it's been providing most recently.
Thank you, Doug. Harris.
It's my turn.
It is your turn. We'd like to hear it is your turn. I'd like to hear a little bit about, from the owner's perspective, addressing how you view the capital markets, alternatives available to you, and how you might use those tools in your job.
Well, by being a public company, by virtue, you need to have an access to the capital markets. Now, I don't think when we talk about the capital markets, we should use that in kind of a generic term. We should distinguish between equity capital markets and debt capital markets, and they have different dynamics, the two of them. I think in general, both should be used in doses. They are not for everyone, and there are certain pitfalls along the way, whichever path you decide to go. If you're looking for a more longer-term investor play, somebody to come in with sticky money, then obviously you will, in most likelihood, opt for the equity capital markets, either through an IPO, which is probably more difficult to do today, or if you're an established operator like we are, and the markets kind of permit, then a follow-on offering is a more pertinent way to tap the equity capital markets. The debt capital markets, on the other hand, bonds and more structured debt securities are a little more dangerous in the sense that they have a short-term outlook from the investor's standpoint. Usually they have anywhere between, call it 3 to 5 years, maximum probably 7 years. Usually, the goals are not aligned between the investor and the owner. So at some point, they must find a way to kind of depart. So in this scenario, companies, depending on their needs and their growth programs, because the capital markets should only be used for growth in my book. Otherwise, especially the debt capital markets, because there is no point in raising debt, which immediately incur a cash cost to the company, and not having a project that will immediately start generating revenues to cover that cost of capital that you are imposing on yourself. So you should, weigh up your options, see what are your long-term needs, and then, act accordingly. But access to the capital markets, it's very, very important for a public company, and for the reasons that Doug mentioned, not only for somebody to come in, but also for people to exit. So that gives you, especially if the stock is very liquid, that allows existing holders to sell and move on, or other people that do not have the capacity or appetite or what have you to buy directly into the physical asset. Then obviously that gives them a way in a tanker company, a dry bulk company, container company, through small investments into these sectors.
Harris, thank you. Stavros, let's turn to you. Seanergy has been quite active historically in the capital markets, and recently we all know about the United spinoff, which was heralded in the media. I was wondering if you could turn a little bit and discuss your perspective on the capital markets, and maybe give us a little flavor for the spinoff process and how you use that effectively.
Definitely. So, yeah, we have used the capital markets both in Seanergy and in United over the last 18 months. To me, I mean, capital markets continue to be a very competitive source of funding, especially in today's interest rate environment. Now, what we did, of course, valuation is not always there, so it's also a metric of whether the issuer is prepared to accept the valuation that is being posed by the market. And valuations, both in dry bulk and in containers, have gone down a lot for someone to consider raising equity in today's market. At the same time, balance sheets are much stronger, so issuers don't really need to raise equity. And having said that, it's always better to raise equity opportunistically, not when you need to do so. So what we did in Seanergy back in the beginning of 2021, we raised equity at a valuation almost 2 times our NAV, and we used the funds accretively to acquire second-hand quality Japanese vessels right before the market rally, to delever the balance sheet, and also to make our ships more efficient through installation of energy-saving devices. Going to United, our small sister, which is more of an opportunistic kind of buy low, sell high type of vehicle with an entirely different strategy. Here, we spun out one of our older ships into United in July this year, and we were very swift in agreeing in a small tanker fleet acquisition, which has appreciated by 50% in value since. So depending on the strategy, whether you are prepared and ready to take advantage of opportunities that come up in the capital markets, it's a very reliable and a very efficient source of funding.
Stavros, thank you. Just turning now, as you all know, we've heard a lot today about the effect of the crisis in Ukraine on charters, on vessel values. How is this going to affect, do you think, either in the short or long term, investor behavior when it comes to investing in shipping? Now, we've heard a lot where people have, in recessionary times, thought of shipping as almost a hedge against inflation. I don't know if it's an exact hedge, but certainly I think investors may think of it that way because the steel value does have, there is a floor, there's a scrap value, it can't completely disappear. But how do you think in today's environment with the crisis in Ukraine and the fact that, shipping companies need to raise a tremendous amount of capital in order to finish their decarbonization projects, as well as take on new tonnage, more efficient tonnage? How do you see, again, Ukraine figuring into the normal dynamics? Maybe, Doug, you can start with this question.
Sure thing. Thanks, Rob. So I actually think it's unfortunately helpful for, capital raises within the shipping industry, and once again, focusing on real-time, data points. We all know that global turmoil tends to help out our industry. And whenever you have an instance like happening in Ukraine right now, it creates a lot of macro uncertainty, so the rest of the market is a bit skittish. Our industry is doing well. So when you go to the capital markets, you say, hey, we've got a sector where you're losing money and everything else. Here's a sector that works. It makes it easier. Versus whenever you have all these other offerings out there that are doing well as well, it's a little bit more challenging to get the investor's attention. But whenever you have a name that works, then it's pretty easy. And once again, a month ago, you do a secondary, nearly $200 million, that discount was less than 9%, which is really, really tight from a historical precedent standpoint. So I think it's helpful.
Do you see a distinction between debt and equity in terms of kind of the larger financings?
Yeah, well, I think as Harry was mentioning, the debt markets, it's different, and even in normal times, it's a bit different. I guess we haven't seen as much in the way of debt financings as all these equity financings that I rattled off. So maybe that's kind of indicative of one challenge versus the other being a little bit more favorable.
Why don't we actually skip over to Stavros, because I'd like to hear a little bit about your perspective. The dry bulk market dynamics and being primarily a Cape owner are a lot different than the tankers. So I think let's start with the dry bulk side here.
Definitely, and I think the crisis in Ukraine, if you look at it from a broader perspective, what it has exposed the weaknesses of the world in planning on energy security. It's clear after the Ukraine crisis that in order to maintain steady electricity production, you will need to rely on fossil fuels, you will need to rely on coal, you will need to rely on natural gas, to some extent also on diesel oil. And there have been lots of underinvestment over the last 10 years. And apparently, I think that although it's a bit early to judge now, but I think that raw materials will feature prominently amongst investors in the years to come. And Cape sizes and dry bulk have a role to play there. So our market has softened a bit temporarily, but I think that investors should still be excited to enter the space now. It's a very strong buy, and if not in 3, 6, or 9 months from now, within a year, dry bulk will go again ballistic.
I'll turn to Harris, see your perspective, and maybe speak a little bit about the recession that some people seem to be expecting for 2023. It seems you can't turn on the television in the United States without someone prognosticating that there will be a significant economic downturn going into 2023, and how that might affect, the interplay that you're seeing in terms of capital markets.
We're a bit fortunate in the sense that, the inherent cyclicality of the tanker industry, in a way, has benefited from the current turmoil just by structural factors. Not many vessels are around today. We're talking about the lowest order book in history, probably 30 years plus. I read a statistic yesterday that only 2% of the orders that were done in 2022 were tankers. So no matter the situation with the economy, we feel that, and just by market fundamentals, that we are, at least for the short to medium term, we're quite insulated. We have the development of new trading routes. The ban of Russian exports from December for the crude and February 23 for products. That will create new trading patterns, elongation of route, meaning capacity will be taken out, supply will be taken out for longer periods. And the current vessels in the water, we could find ourselves in a situation where not many vessels, there will not be enough vessels to carry the necessary cargoes from longer term loading areas to Europe, for example. So because of that, because of this dynamic that the war has created and the low order book and the increase in demand, and hopefully the Chinese starting to turn on the no COVID policy, that will eventually fuel more global oil demand, which we have seen coming back after the COVID. I mean, we are more or less at the pre-COVID levels. We're probably 1 million barrels kind of under, but I feel very comfortable that over the next few months, the market will eventually go back to those levels. So because of that, because of this insulation, if you like, that the tanker sector is offering to the investment community, I believe that they will overlook any potential, kind of call it short-term inflationary headwinds and start investing and coming back en masse to at least in our case, to tankers, investing in tankers. I mean, we have seen our share price doubling over the last 6-7 months since the war started. We are at 16 and change. Probably our NAV still under NAV, probably somewhere in the, call it mid-20s, if not higher. So still some way to go, but much, much better than the $7 and $8 valuations that the market was ascribing to us. And I think it's very important today that we are finally, it seems that, and probably Doug can confirm, and we're finally starting to see more sticky money coming back into the sector. We're getting away from the short-term day traders, and we're having longer-term investors understanding the industry, understanding the risks, and seeing value in tankers and the new, call it the new tomorrow that is coming upon us. Because even if the war ends, let's be honest, if Putin stops the war tomorrow, the sanctions are here to stay, the new trading patterns are here to stay, not enough vessels will be around to carry the stuff, rates will skyrocket, asset values we're already seeing, which in a way they act as a signal to what is expected to happen. We have seen asset prices going 20-30% up in just in the space of 2 or 3 months. So we are seeing, the tanker sector being kind of the next big thing in shipping, and hopefully that will eventually get translated to better valuations, which we're beginning to see now.
I did look at your stock price, and it
Did you
just
buy?
about it. I'm not permitted, but listen, it just about doubled since January 3rd.
Correct.
Which is amazing.
To Harry's point, I mean, you are seeing stickier investors, more long-only guys going in books. I mean, shipping is now being termed counter-cyclical whenever you're talking to all of these investors. And so if you have counter-cyclical whenever inflation is high, and even if you're heading into a slight economic downturn, with no order book to speak of. I mean, this is, it's not just going to be counter-cyclical for a while. You're going to have, like, for the foreseeable future, you have no supply response.
Because don't forget, investors, especially the long-term, the long-onlys, that they are coming back into the sector. They are not taking the short-term approach, meaning that they expect higher dividends going forward. And every tanker company today is awash with cash. So eventually, that could translate into higher dividends and attract that kind of audience down the road.
Yeah. Well, one other thing you mentioned was NAV and the relationship between NAV and your stock price, and how that could affect your ability to tap the capital markets. Maybe, Doug, you can address that. Can a Taylor get done in this environment? It seems like just about every shipping company is trading below NAV at this point. Where are the bright spots, and is it possible to float a new deal, a new issue?
I think for sure. Whenever Taylor approached us in late 2019, we looked at the U.S. capital markets and we saw all the dry bulk peers trading at 75, 80%. And we said, this is not a market for you. So then, we explored other types of structures and settled on an investment company, a trust, because, late 2019, the world was yield starved. And so you created a dry bulk fleet of smaller vessels, looked at the historical cash flow, created a reserve account for whenever things got good. You put some cash into the reserve account such that whenever things inevitably got bad, you can dip into the reserve account. But, it got done in a market where the U.S. peers are trading, as mentioned, 75, 80%, and it got done somewhere right around NAV. So it's not that dissimilar of an environment that we're in today than we were in back then whenever Taylor did get done.
Thank you. Stavros, another thing that Harris just touched on is the topic of dividends. Dividends continue to be a driving force in shipping equities. And the question is, can shipping companies continue to pay attractive dividends and maintain their institutional investor bases in light of what's going on volatility-wise? And, a juxtaposition to that is, obviously, if you have cash on your balance sheet, what are you going to use it for? Are you going to use it for capital investment? Are you going to use it to buy back some stock? Many companies do have stock buyback plans. Or are you going to use it to reward your shareholders with a dividend? And how do you view the decision tree on those type of things?
Look, speaking dry bulk and capes, I mean, earnings have indeed softened a bit lately. But not to the extent that they cannot justify dividends anymore. Dividends continue to be sustainable, so at least we aim in continuing paying dividends. Of course, the absolute amount may be less, but at the same time, the share prices have declined. So in terms of payout ratio, it should be similar. And of course, every company has to follow a balanced approach between capital expenditures and dividends. At the end of the day, we own depreciating assets. We have to cater also to replenish the fleet, to renew the fleet. But at the same time, investors appreciate hard cash, because otherwise, I mean, the only way to realize return on their investment would be to sell part or the whole of their positions. So I think a balanced approach between keeping some reserves to ensure that you have adequate capital to renew the fleet and continue your operations, and rewarding with dividends your shareholders, that's the way to go.
Harris, any thoughts?
No, I'm a big proponent of dividends. I'm not a big proponent of what I call the elevator dividend. So you give, dividends, up and down, depending on the market. You should have a certain set policy based on whatever your net income. You can figure that out, and stick to that. You can adjust it, perhaps at some point later, but very importantly, you shouldn't stop it unless the survivability of the company is, in question. Even give a penny, but it's very important not to stop it, and that it's a policy that we followed, and we found collateral benefits back in 2013-14 when the market wasn't going our way, the stock price wasn't valued at the levels that we wanted to. At that time, we wanted to access the capital markets. We had a big growth program. We were entering LNG, shuttle tankers, and a number of other projects on the conventional side. We needed to raise money. We wanted to raise money from the capital markets. And this historical track record in paying a dividend, irrespective of market cyclicality, even at a lower number, enabled us to access that untapped at that time from shipping companies market, which was called the preferred shares market. Because it was very important to show to these preferred investors, retail investors, that the company, through thick and thin, has the ability to pay something, something on the common stock, and that gave them the comfort that the company will always honor its obligations on the coupon, which obviously has been the case. And that enabled us, that track record of paying a dividend to access that market. So yes, it's very important for a company to pay the dividend. Now, obviously, you should kind of adjust it, depend on your growth, aspirations. But investors need to get something back as the company is making money. On the one hand, and then you can let them, it's up to them to stay with the company as the company grows and have the capital appreciations down the road, the capital appreciation.
Doug, how do you, you see it from the investor's point of view. How do they feel about
I could not agree more with what Harry mentioned about, the whole variable dividend policy not really gaining a lot of traction. I mean, there's been at least 3 companies initiate dividend policies over the last couple of years because we helped their boards decide on what that dividend policy was going to be. And as part of that analysis, what we learned was there was a debate around no dividend, variable dividend, high dividend. It's kind of like you got a benefit, whether it's trading better or valuation uplift, if you're paying a big dividend or if you're paying a small dividend or no dividend. But the variable dividend, there was not much of a benefit. It's just kind of cash out the door. So like Harry's saying, investors sharing and the good fortunes and cash flow of the company is great, but they need to be able to count on it and know what they're going to be getting. So I think it's a key component of that value equation.
Thank you. And I actually had a question about high yield debt. Back in the late 90s, there were a number of high yield bond issues by Greek shipping companies. Yeah. Of course, they ran into the Asian financial crisis and other factors that rendered them kind of painful for the investors. But that was a very high interest rate environment back then. Where do you see the spreads, and how do those deals, a price in terms of is it cheap money, is it expensive money, and how does it rate in relation to equity? What do you think?
You're shaking. You want to take that? I see you shaking your head.
No, it's a dangerous path to follow, the high yield debt today. You're looking at double-digit figures, 12-13% for kind of high yield coupons, if you like, which is double of what you expect to pay from a plain vanilla bank debt. It's dangerous in the sense that if you cannot raise the plain vanilla debt, to resort to the high yield products, because eventually you will end up, paying for that, dearly. It's a dangerous path to follow. You should, again, to my earlier point, use the high yield debt for very small doses, knowing that in the worst case scenario you will still be able to pay that coupon. It's very dangerous.
Yeah, one of my first meetings, I brought my left fin guy into the meeting, and the client is literally laughing him out of the meeting because of the prices that were being quoted. And I forgot the threshold, but it was like, do you realize how many companies that have gone bankrupt that, took on debt that was priced at this? Every single one of them. So, it's just one of those things where when you have that versus the bank debt that's available, that's very, very competitively priced,
Remember when we first met in the late 90s, in the high yield debt bonanza, all of the companies went bankrupt eventually.
Yes, there were many. Anyway, I would like to thank the panel. You did an excellent job. I'm sure the folks here attending enjoyed it, and I'd like to turn it back to Matt.